This episode of the podcast is generously hosted by Progressive Equity Research. Visit their website at progressive-research.com. Hello and welcome to episode 44 of the Desert Island Investor. Fundsmith, under the guidance of portfolio manager Terry Smith, invests in equities on a global basis. And Mark has been invested in the fund for many years and he regularly attends their annual shareholder meetings. Now, in this episode, he's reporting back from the 2026 event in London. So, seeing this is a hot-off-the-press episode, let's get straight to it. So, good afternoon, Mark.
And good afternoon to you, Paul.
Okay, you're fresh back from the Fundsmith ASM, and every year since we started this podcast, you've attended this event, not least as you have a significant holding in relation to your own portfolio. Now, we also use this as an opportunity to reflect on your own performance. So what is the size of your Fundsmith holding compared to your own portfolio?
Fundsmith is 41.2% of the pie, with my own portfolio 36.8%. I also have a third leg to the stool, which is my pension, where I've had several pensions that accumulate and I've consolidated them into Vanguard trackers and they account for 22%. And in addition, coming down the tracks this year, when I reach 60, will you believe, will be a final salary pension from Sappi, who are a paper manufacturer. And I left them back when I was 28, and it seemed like crumbs at the time, but it has galloped along with compounding, and perhaps we'll cover this in a future episode. I have been making some modest redemptions from Fundsmith to support my travelling and fulfilling some long-held dreams and ambitions. And after all, that's what it's for, not simply to look at it on a screen.
Absolutely. Now, for many years, Fundsmith were outperforming the index to some tune, but in recent years, there has been a prolonged underperformance. So how did 2025 look?
Well, the fund was up just 0.8%, and that compares with a benchmark of 12.8%, and that is the fifth consecutive year of underperformance. Since inception, 15 years ago, the fund is up 13.8% on an annualized basis against the benchmark, which is the MSCI World Index of 12.1%. So long term, still positive, and again, that's against the benchmark. So remember, they've not lost money, and I'm glad that I've enjoyed those returns rather than, leaving my hard-earned cash on deposit in a bank.
Why do you think the underperformance has lasted for such a long period?
When you look at a short period of time in investing, like a year, there's generally some phenomenon that's had a burster. Back in the day, it could have been .com stocks, it could be gold, it could be other commodities, it can be a sector, perhaps banks or pharma. But this has dragged on, and it's largely the weight of money that's been going into the Mag 7, aided and abetted by the weight of money that is in trackers. And trackers have many attractive features, but they don't have a brain. It just follows the money. And the weight of money, and it has no consideration for the valuation or the underlying prospects of a business. And I am myself, just said, I'm adding to this in some small way through my pension that's in Vanguard trackers, which are, split across various indices.
Now, this has lasted for some time, though. How long can it continue?
I've no idea, but I doubt, like any bubble, it will last forever. And when it comes to an end, it will be ugly. This was a large essence of the other evening in the presentation from Terry Smith and his 2IC, Julie Robbins, on the night. They were explaining and hammering home this phenomenon and trying to predict, how long it will last.
Do you think any correction or crash will be limited to those Mag 7 shares?
I'm no market expert, but from my experience over 4 decades of investing, there's generally a lot of collateral damage, especially in the short term. What tend to fare best are the defensive stocks. These are businesses that supply products and services that we continue to need rather than want, and irrespective of what the economic circumstances are, and be it insulin or toothpaste. And these are the type of things that Fundsmith find attractive. Historically, the fund has performed best relatively during the bad times.
We hear the phrase Mag 7 quite a lot. So who exactly are they?
It's Alphabet, which we used to know as Google, Amazon, Apple, Meta, which was Facebook, Microsoft, Nvidia, and Tesla.
Right. So this is Mag is the Magnificent Seven. That's
Correct.
basically where they
Yeah.
take that from. Okay. Right. So this bubble, as you describe it, it is a momentum play. I mean, and it's lasted some time. Why have you not jumped on board with your own portfolio?
I've restricted myself to UK equities. It's what I've always done. This is where I've done my fishing. I've local, domestic UK knowledge, and these are businesses I have some understanding of. For one, the MAG or Magnificent Seven are businesses that are way, way outside of my narrow circle of competence, and I have a low buy and I have a buy and a low churn strategy. I wouldn't back myself to read the warning signs and be one of the first out of these businesses if the tide turns. And when the momentum shifts, it shifts quickly.
Okay, so on positives, who were the Fundsmith winners?
As previously mentioned, Alphabet, the Google, IDEX, which are pet healthcare, Philip Morris, previously predominantly tobacco but nicotine heat not burn products, Meta, and Microsoft.
And the losers?
Were Novo Nordisk, who are into insulin and weight loss drugs, ADP, payroll and HR software, Church and Dwight, consumer brands, Coloplast, medical devices, things like ostomy bags, and Fortinet, who are into cybersecurity.
And on the subject of do nothing, which is not meant literally, but limiting portfolio churn, what was out and what was in?
Out went Brown-Forman, who manufacture Jack Daniels and PepsiCo. They were sold on the fear that weight loss drugs are a clear and present danger to curb appetite and profit margins. And in came Zertis, who are a veterinary pharma company. Essilor-Luxottica, they manufacture spectacles in a world where people need vision correction in emerging nations and increasingly be able to afford it. Intuit are accounting software, which they previously held. And Vulture's Kluwer are technical publishing covering health, tax, accounting, risk and compliance and legal. And they also gained Magnum Ice Cream Company, as did I, after it was spun out of Unilever. Now, Unilever is retaining a 20% share for the time being, and it has just, I'm using the word just, a market cap of only 7.2 billion. And the median cap for Fundsmith is 77 billion. So it will be interesting if it has a part to play in the longer term, just to, due to its relatively small size.
So Terry Smith is sticking to his guns, but not all of his investors are.
Terry and Nick Train, another fund manager with a similar style and a similar long-term performance record, do not appear to be keeping all investors on board. Investors are like football fans. They obviously want successful performances every week. Terry is not abandoning his principles, but obviously he's keen to keep his investors, who are his customers. And investors have fear of missing out, and this underperformance of the fund is admittedly taking an extended run. Things may be about to turn, and Terry can say, "I told you so." But looking at the fund, in December 2021, the fund was trading at 670.75, and the assets under management were 28.9 billion. At the end of January, it was trading at 703.65, so it's gone up. But the assets under management were 15.3 billion. So, what's the reason? Well, over time, investors have been pulling money out and perhaps, putting it into the Magnificent Seven. And this matters to Terry. In Norway, he's a pauper, but he and his partners charge 1% on the assets under management. And if you lose, 12 or 13 billion, that pinches.
So what was the tenor of the presentation, and what were any questions?
A very large part was the underscoring of this whole Magnificent Seven tracker trend. And it was a little bit of a carbon copy of previous narratives, but it's still the case, and with various slides showing leg evaluations, weight of money, and a selection of ratios. So partly, you've heard it all before, but it's still valid despite this phase having run for some considerable time, a period that for many, has been too long for them to endure.
So no chance of Fundsmiths scrapping their strategy?
No, they'll stand firm, but Terry did concede when asked a question that there is pressure. There's certainly pressure to do things different, and they've got to try and resist that, as the opportunity cost between his fund and the benchmark has grown. But I doubt he will start rolling the dice to try and magically catch up. What they're trying to chase there are league tables for funds.
Mm. So AI has been around for some time, but its usage has increased significantly in the last 12 months. Now, I know we've used it much more. So was that issue raised?
Yes, the great conundrum is identifying where, if anywhere, people will make money out of it. There's no assurity at the moment. It could be just a destroyer of wealth. If we look at the internet, which was invented by Tim Berners-Lee, he made this free. There may have been some beneficiaries, many beneficiaries from the internet, but I would argue there have been as many, if not more, casualties. The biggest winner has been the consumer. He has, or she has, greater visibility of pricing and comparisons and that's squeeze margins and garner high street. Do you remember high street insurance brokers, newspapers, bank branches, catalogue shopping, travel agents? All kinds of shops. We could go on and on and on. And even with YouTube, your average Joe like myself can watch a few DIY videos and educate yourself on how to do a simple job that a tradesman could have made a tidy sum out of. Now, it was thought that certain businesses, say Relics, Experian, Sage, etc., would be beneficiaries. But suddenly, this has turned into a fear that they themselves could be victims of AI. So opinion is split, and probably at this moment, nobody definitely knows how it will play out. So it's certainly interesting times. Now, Terry used some further examples that through history of inventions that have benefited mankind, but did not generate great wealth themselves for their investors. And he used, in the case of transport, canals, railways, and airplanes, and in communication, the telegraph, radio, TV, and the telephone. I think by profession, Paul, you're a graphic, or you were a graphic designer, and you can type your requirements into a computer and press enter, and you've got an image, and that would probably have taken hours or days by a professional. And you never know, might even be able to replace a podcast course with AI.
All right, thank you. That's a veiled threat. So there was a question about portfolio management and the restrictions enforced on a fund. Now, as a private investor, this is where you have much greater freedom, isn't it?
Fundsmith, and any fund for that matter, cannot have more than 10% in a single holding. I currently contravene that, as I have two, both at around 12%. That's MP Evans and Concurrent Technologies. So if Terry picks a winner, he cannot ride it potentially like I can. And there will be inflows and outflows to funds. So, they're constantly having to trim and rebalance depending on the assets under management. And if you had a winner that goes on a moonshot, you could find yourself constantly trimming it as it's bouncing up against that hard 10% ceiling. The other criteria is that as a fund is not allowed to have 40% of its value in holdings over 5%. So this is where I'm well out of the league here, because I've got 74% of my portfolio in holdings above 5%. You could argue that this is greater flexibility for me, and it's an advantage, but perhaps it also leaves me a little bit too exposed. Perhaps our listeners will tell us what they think.
Now, I believe there were around 200 questions submitted by shareholders, and Ian King, who's best known as the news anchor of Sky Business, selected 10 questions for the night, of which yours was one.
Yes, Ian generally selects a humorous or whimsical question to bring the evening to a conclusion, and mine was actually sent on behalf of my grandson, who is himself a Fundsmith shareholder. And it was, "Dear Terry, like you, I am a long-term investor. I was born on the 9th of July 2025 and have been an investor in Fundsmith most of my life. My parents named me Otis as they predicted I would go up in the world. Otis is also, at the time of writing, a fund holding. If you had to name a child after one of your holdings, which one would it be and why? And that's from Otis Sample. So this raised a few titters, titty not, around the hall, and Terry said he would probably select L'Oreal. But he then shared that he'd recently become a new dad, congratulations, to a son who he had named Thomas Crown Smith after the Steve McQueen movie. He's a big fan of the movie and Steve McQueen. So you never know, this new arrival may spur Terry to soldier on until Thomas is old enough to come into the business. They did say that everybody who, this is the same every year, who submits a question will get an answer privately. Now, I did drop a line to Ian congratulating him on overseeing another excellent meeting and indeed selecting Otis's question. And I know his parents will be thrilled to see the official video. But then Ian asked me how I thought the event was received by the audience. So my feedback was that the audience and the wider shareholder base are understanding but frustrated that the tide has yet to turn. And just recapping, many retail investors are fickle, and even those that they call themselves long-term investors, they generally they're quickly impatient and want that jam today. And perhaps after Fundsmith's previous stellar run, that they thought that there would be some kind of guarantee to this fund. And it must be tiresome for Terry and Julian to keep trotting out the same mantras, but there's little else they can do ahead of that Mag 7 tracker bubble bursting. And the strategy has been articulated as clear as it can be, but nevertheless, it will fall on some, sad for them, some deaf ears. And this phenomenon, it's not unique to Fundsmith. That morning, the morning of the meeting, I had another meeting with Matthew Burrows of Frostrow Capital. And they have 13 fund clients, including Finsbury, and they're all generally feeling that same squeeze. So I'm sure Terry, Julian et al. will rightly stick to the guns, and although they're maximising the communication, there will be a continued leaking of investors through that FOMO. And when it turns ugly, you never know, those self-same investors might come scrambling back. That's if they've got anything left.
Right. Prior to the ASM in December, you were invited to a Fundsmith 15th anniversary event, I believe.
It was actually Elaine that was invited in her capacity as one of Fundsmith's largest shareholders. Elaine has a much larger holding. Did I say lager? That was a.
She's always holding a lager.
Yeah, I know. Yeah, so Elaine has a much larger holding than me. However, everything we duly own is considered team pot. But I was there in the capacity of her plus one. I don't know what the threshold was for the invite, and I did think it was a little too gauche to ask. But it was a very tasteful, intimate event, drinks and canapes with some interesting people there. And I spent considerable time with Daniel Washburn, analyst and partner, who I met with socially last month in Mauritius. Julian Robbins again, and Terry Smith, and key members of his team, Greville Ward being another.
Ooh, so what gems did you glean from Terry?
Well, I'm just wondering where we're up to on the name drop-ometer, Paul, for this episode. But
a bit excessive, I have to say, but I'm bearing with it.
Okay, but a lot of the conversation was not fund investing related. I was pumping them for insights into relocating to Mauritius, and was given some useful information. And I was also asking Terry about his car museum that he's opening on the island shortly, and that's going to cater for around 200 classic vehicles. So we also shared what our first ever cars were. In my case, it was a green Chrysler Sunbeam PCG 557T. It'd have over 100,000 miles on the clock, and it cost me 500 quid. So, do you remember what yours was, Paul?
My first card was a Ford Escort. It was black, and it was in terrible condition. It was actually painted in missile black. I bought it from a guy who worked at British Aerospace. I asked him what colour black it was. I thought I'd go to Halfords and get a touch-up. thing for it. But apparently they sprayed it with the same paint they used on the nose cones of missiles.
Yeah. And not battleship grey then, missile black.
Missile black, yeah. Unfortunately, underneath the missile black paint was considerably stronger than the car, and it was just the paint holding it together, I think. Right, so away from Fundsmith specifically, but from the same stable, Smithson is transitioning from an investment trust to an OEIC. What's that all about?
Well, we call that an OIC. I don't think we pronounce in the trade, Paul. We
I'm sorry. Okay,
yeah, you'll pick these things up over time. So there's been activist pressure from Cyber Capital. They've been very active in various places. So despite constant buybacks, the Smithson have persistently traded a discount to its net asset value. It's not uncommon, and Fundsmith also had the FEAT, which was the Fundsmith Emerging Equities Trust, and as the name suggests, this targeted emerging markets, which I'm increasingly interested in, but it never really gained traction and was liquidated, I think it was back in 2022. So in both cases, I would imagine that these have caused some distraction from the main fund.
Okay, moment of truth. How did you fare in 2025?
Well, I was quite smug the year before. Fundsmith did 8.9%. I use Fundsmith as my benchmark, really. And I recorded 25.5%. So in 2025, Fundsmith set the bar very low with that 0.8%, but I failed to beat that, Paul. I recorded minus 3.2%. So that's total return, which is with dividends reinvested.
Reputation, such as it is, in tatters then?
Well, let's not be frightened to heap on the comparators. So the FTSE 100 was up 21.5%, and I could make an excuse. Well, I don't invest in the FTSE 100. I'm in smaller stocks than that. So let's go below the FTSE 250. That was still up 9%, and the AMO share was 6.4%. So I've underperformed all of those. Right? Let's get that out there. Balance that against the previous year, up 25.5%. Portfolio returns will and can be bumpy and whipsawing, and it's not a constant and predictable thing like fixed income in a bank account. It's often not a practice, they say, for widows and orphans. However, ironically, it would often be their best solution over the long term. Mining and banks did really well in 2025, according to TrustNet. Fresnillo, who were a silver miner, was up a mere, listen to this, 447%. So well done to all those that rode that. I had two miners, Camel, and one that I've sold, which was Rio. So I've subsequently sold that this year. And I had a bank, Barclays, but they weren't my largest holdings. So Barclays was my top performer in percentage terms. That was up 77.6%. So I actually sold that together with Rio in January. I had previously held it for 20 years, but for reasons I've previously elaborated on, it should never have been in my portfolio, as I don't have a command on banking. So you just watch that share price go now, Paul. It'll probably go on a really good run now that I've sold it.
Right, so to cut to the chase, your performance was crap. What went wrong, Mark?
Yeah, well, thanks for that. You've got to use the euphemism, Paul. So it didn't exactly go wrong. Like I said, my performance is not calibrated to any index. Last year I was not getting carried away, and equally this year I'm not beating myself up. Both are dangerous emotions. You have to try and remain dispassionate, and I'm not an expert or a professional. We've no customers or clients, so I can be transparent without fear of complaint or criticism. What we provide is a private investor diary, and where others may wish to adopt some practices or skills like navigating a period of underperformance. Lots of private investors will have done better than me, and good luck to them. You must remember that the performance of other investors does not impact your own life. We talk about underperformance. We private investors, we're not in a league table where somebody faces relegation, or in the workplace where you're hauled into personnel because you're trailing other colleagues. Even in truth, your performance is acceptable. You could have returned 20% and be dissatisfied that you trailed the FTSE 100. Again, it's a better return than money on deposit, and I'm running my portfolio, and I'm running the portfolio to fund my life, not as a competitive bragging rights exercise.
So what were your respective winners and losers then?
Well, I'll not go through the whole portfolio as it will be tiresome. What really turns the dial are the top holdings, and I'll give you the top 10 as it stood on the 1st of January 2025, which is not necessarily what is the top 10 today. So Me Group was down 26.9%, MPAC down 41.3%, Smurfit down 33.4%, MP Ovens, hallelujah, we've found one that's gone up 23.6%. Greggs was down 39.3%. Tesco up 19.9%. Concurrent, this is a bit better, up 61.1%. Unilever up 7%. Somero down 32.3%. And Titan up 15.6%. Now, anybody running average stop losses would have exited a lot of these, and it would be too much to bear. I'm quite happy with the balance of my portfolio.
And regarding what you brought in and what you let go, talk us about that.
Yeah, well, I disposed of Shell, which was another what I would call legacy holding. It's a pity that we couldn't have used that for one of the episodes, because I think we could have got some mileage out of the Shell theme on the beach. But perhaps that's a lost opportunity. I did have a takeover of Alliance Pharma, which I was disappointed to see go. And in came Intertech, which we've covered in a previous episode, and again Magnum through that Unilever hive out. So I did a total of 11 trades in the year, which in terms of cost is very low. And remember, it's not just the trading fee bit, but also the spread and the stamp duty that you have to pay, and having to learn about a new business.
And how has 2026 started?
Paul, I don't even like using 12 months, never mind 2. Let's look back again in another year's time. I'm very happy with the profile of the portfolio, and hopefully I will have a better year. Just returning to Fundsmith, last month they revealed in their fact sheet that Sage had returned to the fund and out went Intuit. So both are in the sphere of accounting software, which I have about as much command as that of scatter cushions. And I'll subcontract that onto Terry and the rest of the team. But Fundsmith exited Intuit in December 2022 and announced that he'd been brought back into the fund only in April 2025. And once again, it's out. And Sage was exited in May 2021, and it's back in. So no questions were raised about this at the ASM, as it only covered the last year. But the rationale in the fullness of time will be interesting. It seems a little bit like the hokey coke, in, out, shake it all about. So wait for that. But in conclusion, Paul, you do say that I never give you anything. I would just like to provide you with a very nice Fundsmith tote bag and pen. So here you go.
Thank you. Yeah, thanks very much, Mark. That's going to be very useful to me. And thank you very much indeed for your review of the Fundsmith ASM and your confessions about your performance of your own personal portfolio.
Yeah, it's been very cathartic, Paul.
Yes, well, it's good to get these things out into the open, isn't it? Really, there's no point pretending things are going well when they're not. And I think if we're all happy and done, we'll call it a wrap. Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. Thanks again for listening. See you next time.